This is Taking Stock on Bloomberg. I'm Pimm. Major companies have been taking advantage of record low borrowing rates in order to pay for acquisitions. Companies such as J&J, Google, they've all been tapping the debt market. Now, as that activity picks up, what about middle market companies? Well, my next guest says that some lenders appear to be loosening the financial requirements. Ronald Kahn is a managing director of Lincoln International. He spent more than 15 years handling corporate finance transactions at Duff & Phelps and Maestro Financial. Good to have you with us on Bloomberg.
Good to be back.
All right, so Lincoln International, your focus is middle market companies, and we were just talking during the break. You're not interested necessarily in dealing with companies that are on the internet and so on. You're dealing with companies that make things you can touch with your hands and go on shelves in terms of inventories, right?
Exactly. Industrial companies. Consumer products companies, healthcare companies. And we define middle market as companies that have EBITDA, earnings before interest, taxes, depreciation, and amortization, of less than $50 million. Probably more than $3 or $4 million. So between $3 and $50 million is what we define as our market.
So typically companies that are not going to be able to tap the debt market like a Johnson & Johnson. They're not going to be able to issue debt.
That's right. In order to access the high yield market, you probably need 50 million of EBITDA and above. This is that segment that can't get into that market.
So what kinds of capital, what kinds of financing are available to these firms?
Well, what's interesting is it's really come back, and there's a lot of different products that are out there. For senior debt, there's always been asset-based lending, which is based on collateral value, a percentage of your receivables in inventory and fixed assets. There's also cash flow money based upon your EBITDA, a multiple of that EBITDA that you can borrow. But now there's also subordinated debt products, which come junior to the senior lender, and there's this new product that's on the market called the unitranche.
The unitranche. What's the unitranche?
A unitranche is where they combine both the senior and the subordinated piece into one large piece. And we're seeing a lot of BDCs and hedge
business
funds,
development companies,
which are publicly traded, mostly on the New York Stock Exchange, providing that unitranche to these middle market companies.
Where are they getting the money to lend to these middle market firms?
Interesting. They're raising it primarily from both retail and institutional investors. A BDC normally has a dividend of between 8 and 10%. Hard to get 8 and 10% today in the market. So they float their stock. It pays an 8 to 10% dividend. They get the money and they lend it to middle market companies. In just the last year, new issuances of BDCs, $750 million. Follow on for existing BDCs, close to $1.3 billion. So that's $2 billion of equity that's raised in the last year. BDCs can leverage that capital one-to-one. So that gives you $4 billion of new capital coming into the market. And we know of probably another dozen BDCs that are in registration right now that are trying to go public.
Well, if that happens and you get this additional capital in the market, isn't that going to push up the price? I mean, you've got more companies there competing to loan money to
which
these.
Brings down the price for the borrower.
For the borrower, but I mean, for the lender, it's going to cost more, right?
And it definitely have. I mean, we were doing sub-debt pieces during about a year, 2 years ago. It's 16 to 18%. That's probably down to 12 to 14%. Unitranches, which were in the 10 to 11, are probably closer to 9.5%. So the yields have definitely come down, which benefits borrowers. On the flip side of that, the leverage has gone up. So you can borrow a multiple of your EBITDA. In the height of the crash, it was only 3 times. So you take whatever your earnings were, multiply it by 3. That was the total debt you can get. Today, it's closer to 4.5 to 5 times. Really, really big difference.
So you're seeing that a lot of middle market firms are taking advantage of this? Because I got to confess that every time we do a segment in the middle market or small business, I always get an email from someone saying, nobody's lending. These guys can't get access to money.
No, again, it's not necessarily coming from the banks. The banks do some, but they don't really like the middle market. It's coming from finance companies, hedge funds, BDCs, and some insurance companies.
Non-bank financial companies.
Exactly. And they're finding a real desire to put money out.
And what about putting that money to work? Are you seeing the kinds of returns that are going to be able to sustain paying someone 12%? I mean, because that is not inexpensive.
Well, the interesting thing is most of the capital to date has been used for refinancings to extend extend maturities and bring down your interest rate for acquisitions or for dividend recap. We have not seen that much just for growth because companies don't want to incur that high debt to increase their capacity because they've got enough capacity.
So this isn't good. So you don't think that, at least right now, this is going to end badly?
So far, it looks pretty good.
People are being a little bit mature and sophisticated in terms of what they use the money for.
They are. And if they are making an acquisition, they still need to capitalize it with a minimum of 35 to 40% equity. So there's a pretty big cushion for a lender that if things go awry, they still have enterprise value. They have the value of the business that they can sell if they need to.
Is that equity piece greater now than it has been in the past, let's say in the last 2-3 years?
No, it's actually been lower. In the height of the crash, it was close to 50%. So just like lending a house, whatever you had to put down as your down payment, it was 50%. Now it was 3 months ago it was probably 40%, and now it's 35 to 40. So things are definitely getting more aggressive.
All right. Now, as you mentioned, the yield on many of these business development corporations maybe 8, 9, 10% in some cases. So people chase after this yield. Do you think that that is a problem right now? Because it looks great now when companies are doing well. You say that they're able to borrow against their inventory or against their assets, but if the business somehow shrinks, how are they going to maintain that kind of payment?
Then they will have trouble. But even through the crisis, BDCs, and they've been around for a while, have always done all right. The only BDCs that have had problems is where they get a little greedy and invest in the equity or decide to become private equity groups and buy
operators, right? I mean, this is always the fine line. It's like it's okay to be a lender, but don't necessarily pretend that you know how to run the business.
Exactly. So the ones that have stuck to their knitting and continued to do lending have continued to do well.
All right. I want to thank you very much, Ron Kahn. Always a pleasure. Lincoln International giving us some perspective on the middle market and lending out there.
Thanks.
Always well done. Thank you.